Good evening and welcome to another live webinar with Food Futures. This is your facilitator for the day, and this is Sri from Food Futures. Today we're going to be discussing high probability trading strategies for BMD CPO futures. As you know, CPO is a product that's very close to the hearts of many traders in the region. And looking at our registration list, I understand that we have a high number of Malaysians joining us, and CPO is very much one of the key products in Malaysia. Today we have special guest David Low, who's the managing director of Zomodius Trading Group, a consultancy firm that specializes in bespoke trading strategies and coaching services for both private and corporate clients. He has over 24 years of experience in the Malaysian listed derivatives industry and has had several leadership positions. And he is also the immediate past president of the Malaysian Futures Brokers Association from 2018 to 2019. So the key outlines for today's webinar is understanding and reading trends from CPO charts, recognizing high probability setups for entry and exits, day trading or position trading, and implementing risk controls for CPO trading. This is, of course, very important when it comes to trading. All right, David, if you're all set up, I'm going to hand the reins over to you. Are you all set?
Yes, I am. How's the audio?
The audio sounds good. Just a request to our audience. We have 109 of you here. If you can hear us loud and clear, please type yes into the question box. We very much appreciate that. All right, thank you, Suin. Muhammad, Irwin, thank you for confirming you can hear us very clearly. All right, David, over to you.
Right. Thank you very much for the wonderful introduction. And first and foremost, big thank you to Phillip Futures for hosting this event. And most of all, thank you for all of you who have come in to join this webinar this evening. I hope everybody is taking care and staying safe. We have a lot of information to share with you tonight under this theme called High Probability Trading Strategies for CPO Futures. I'm basically going to share with you the trading system that I use myself personally. I've been using it for many, many years. And I understand that there are a lot of Malaysian traders as well. And a lot of you have just started trading CPO. Fantastic. Welcome on board. Hopefully the information shared tonight with you will find useful. I also understand there are some very seasoned traders here as well. So thank you for joining us as well. And I hope you have a good session as well and take home some useful pointers as well. All right, so let's get started. So before I start, a quick disclaimer. This presentation basically does not constitute a recommendation and offer to buy or sell any of the futures contracts or investment products in the presentation. Those of you who wish to buy or sell the futures contracts and all that may refer to your futures broker at Phillip Futures. All right, so that's the gist of the disclaimer. It's quite wordy. So let's get on to what we have tonight. So this is what I'll be sharing with you tonight. Basically 4 points. The first is understanding and reading trends from the crude palm oil futures charts. We're going to look at charts, technical charts. For those of you who've just started, do not be afraid of charts. I'll be showing you charts that you'll be hopefully find it very easy to understand. Okay, so first, how to read the trend, how to understand the trend, and from there, how to pick up high probability setups for entries and exits. Okay, how to find buy entries, sell entries, how to exit the markets and all that. Then we'll also talk about should you be taking a day trading kind of position or should you be position trading. Okay, so how to choose your optimal FCPO trading strategy or style. Okay, we're going to cover some of that. And lastly, and most important thing about trading futures is how to implement risk controls. We'll be sharing with you how to put stop losses and how to manage the risk of trading FCPO. So those are the 4 key points that we'll be covering tonight in our presentation. Okay, just a quick refresher on the futures contract that we will be covering tonight. We will be, of course, talking about Bursa Malaysia Derivatives Crude Palm Oil Futures contract. In short, the code is FCPO. The FCPO has been a long time in the market, since the 1980s. Okay, it's Bursa Malaysia Derivatives flagship product, the most heavily traded contract on Bursa Malaysia Derivatives. This is a ringgit denominated crude palm oil futures contract. Bursa Malaysia BMD also has a US dollar crude palm oil futures contract, but the Malaysian ringgit CPO contract is the most active. And each of these contracts on FCPO is equivalent to 25 metric tons of crude palm oil. That's the size of the contract. So the key features of basically BMD, CPO, FCPO is global access. Okay, it's interesting to know that every time a trader keys in a trade into the system, all the orders, the buy and sell, all the orders are done and actually matched in the Chicago CME, Chicago Mercantile Exchange Globex system, and that's in Chicago. So whatever is matched on every single trade is actually matched there. So we have global access, and a lot of international players actually are actively participating in the FCPO contract. Right. So this, of course, when you trade the FCPO, you have exposure to the world's largest produced and exportable edible oil and fats. It's a global price benchmark for edible oils, FCPO contract, and is internationally recognized and tradable. Of course, you're looking at currently in September, FCPO traded 1.28 million contracts, very, very active. And a lot of this are also position held. There's open interest of more in excess of 200,000 contracts. That means traders are holding positions of over 200,000 contracts at the end of September. So very, very active, and increasingly so with the volatility in the global markets. So a lot of diversified users. You have people in the business, in the palm oil business, the planters, the traders, the refiners. You have the speculators as well. You also have the commodity funds. You also have the algo traders in this contract. So it's a very, very international and very diversified contract, which makes it a very, very good contract to trade. So this is the contract spec. This is a summarized contract specifications for FCPO. Of course, the underlying is the crude palm oil, and the size is 25 metric tons each contract. And the minimum tick, that means every single price movement in the FCPO is 1 ringgit. Okay, so every contract, every time you buy or sell a FCPO contract, if it goes up or goes down by $1, a ringgit, then you have to multiply by the 25 metric tons. That means every single ringgit movement in the palm oil price is a 25 ringgit movement in per contract in your futures position. All right. So trading hours is opens at 10:30 a.m. in the morning to 12:30 p.m. Then takes a break and reopens at 2:30 p.m. until 6 p.m. Right. Now, in terms of the contract months, those of you who are not in the business of taking delivery of crude palm oil, because this is actually a physical delivery, you can see here the settlement. It is a physical delivery contract. That means if you hold until you get delivered, you will get 25 metric tons of crude palm oil delivered to you for every contract that you hold. So of course, the brokers, if you're not in this business of taking physical delivery of palm oil, or you're not in business of buying, selling physical crude palm oil, then most of the traders will trade what we call the third month. Okay, the third month is the most active month for trading palm oil. So for example, we are now in October. The current most active month is the December contract. So if you want to, I'll give you some examples afterwards. If you are buying and selling currently, you'll be traders are looking at trading the December month. Of course, in terms of the expiry of the months, the next couple of days you will see what do you call that? Some of those months expire, and then we'll move into January to trade that particular contract as the third month. Now look at margins. Okay, margins are important as well. The margins is 4,005 currently. Of course, this changes from time to time depending on the volatility. 4,005 is the minimum amount of margin you need in your account to hold one contract of FCPO. Now, in terms of margins, some brokers may have different levels of margin. So please recheck with Phillip Futures on the margins that they have. Normally, it's the same as the exchange margins, but some brokers do have some varying margins as well. Right, so in order to hold one contract of the FCPO, the exchange, the clearinghouse requires at least 4,500 ringgit in your account. All right, so that's the summary of the FCPO contract. So let's get into the action. I'll give you a few examples in terms of, for those who are new, just in case you are new, you have not started trading FCPO yet. So just give you an example. Now, this first example is a bullish scenario. Okay, so if you feel that the commodity markets globally are looking very bullish, and you feel that also the same trend will apply to the Malaysian CPO market, so you are bullish. What you can do is you can go and buy one contract of December CPO futures. Okay, and for example here, if December FCPO is trading at 2007, okay, a futures trader will enter a long position. Long is a terminology that we use in futures. That means that you have the view that the market is going up, and so you buy one contract of December futures at 2007. Now, there are two scenarios that can happen. The first scenario, of course, you are correct, and lately also the FCO prices have been going up. So if you find that December FCPO rises to 2008, right, compared to your entry price of 2007, there is 100 ringgit gain, right? So 2007 per metric ton, that was the price that you bought, and it rose to 2008. So if December FCPO now at 2008, your long position in your futures will gain actually 100 per metric ton. And since the contract is a 25 metric ton contract, you have to multiply that with 25, so you get a 2,500 ringgit value in gain. Okay, so if you're right and it rises 100 ringgit, then you have 2,500 ringgit gain in your account. Now, sometimes markets don't move exactly as you want. So if December FCPO drops to 2006, okay, it's dropped, you bought at 2,700 and now it's 2,600. There's 100 ringgit loss per metric ton. So in that case, your position will be 100 ringgit times 25, you have a 2,500 ringgit value loss. Okay, for those who have questions, you can share your questions in the chat box, and later after the main session, I will go into the Q&A and I can take questions at the end of the session. All right, so this is a bullish scenario. Now, in case you are bearish, okay, you feel that maybe FCPO is around 3,000 ringgit is top, so it looks like it's going to come down. If that's a view, you have a bearish scenario, you can, of course, go and short sell, short the position. That means you can sell December FCPO, and let's say, for example, if the price is at 2007, similar to the previous example, so a trader goes in and actually sells one contract of December FCPO at 2007. So again, two things can happen. If it goes your way, December FCPO drops, okay, because your view that prices are going down, and actually December FCPO drops to 2006, then you have a gain of 100 ringgit per metric ton, and you multiply that by 25 metric tons, you get a gain of 2,005. Similarly, if December FCPO were to rise by 2008 and that goes against your position at 2007, you would have a loss of 100 ringgit per contract multiplied by 25. Then you would have a 2,500 ringgit in a loss. Okay, so in terms of calculating the P&Ls, it's actually quite simple. What is the movement in terms of ringgit in the market, and then just multiply by 25, multiply of course by the number of contracts that you're holding. Okay, so this is a quick easy examples of how to calculate the P&Ls and if you are trading a bearish and bullish markets. Of course, there are many other different types of strategy, but this is just a plain vanilla buy and sell in the FCPO futures contract. Okay, so let's go to the gist of today's topic, which is basically high probability trading setups. Okay, but firstly, we need to learn how to read the market trend, and then we learn how to trade it. Okay, in terms of looking at markets, there is this theory called the Elliott wave theory. Okay, and this was first brought up by this very keen student and observer of the market, Ralph Nelson Elliott, I think in during the 1950s, and he is the father of the what we call the Elliott wave theory. Okay, and the Elliott wave theory is used a very popular tool for for forecasting the markets. Okay, and in terms of Elliott looking at the markets in his theory of the Elliott wave, basically what he was talking about is he basically observed that the market actually move in a very orderly and repetitive wave-like patterns. Okay, and in terms of the Elliott wave here, actually I have an illustration here which you see on the slide. He says that in any particular and this is a bull trend. He's saying that in any particular, say, a bull trend, and this is upwards market bull trend, there are a 5-wave movement. Okay, you can see here wave 1, wave 2, wave 3, wave 4, wave 5, and then 3 corrective waves. Okay, so in terms of his theory of looking at the price charts of whatever commodity, or at the time he was also analyzing the Dow or the equity markets. All these prices move in a wave-like fashion. Okay, very interesting. And in the 1980s, okay, you had this branch of mathematics called the modern chaos theory. Okay, and a lot of the practitioners of modern chaos theory, okay, basically applied it, tried to apply it into the markets. Okay, and what modern chaos theory showed is actually in a very seemingly chaotic market movements, right? A lot of people, when they look at the market and say, wow, the prices are so wild and it's like so chaotic. Okay, but actually, according to this branch of mathematics, in this very dynamic chaotic market, there's actually order of very high degree. Okay, just like in nature. Okay, because the modern chaos theory was what do you call that, came out to measure dynamic systems. Okay, and so it measured natural systems, and it can also measure market movements. Okay, and in terms of the chaos theory, there's this thing called fractals. Okay, and financial markets and commodity markets actually exhibit fractals like in nature. Right, and we're going to talk about fractals. Fractals is what we are going to look at afterwards. So in terms of fractals, okay, and I'm a student of this Dr. Bill Williams. Okay, I learned from him many years ago, since the 1990s. Okay, and he was the one that came up with this fractals indicator in the technical analysis software. Okay, so we spoke about the chaos theory and how markets are both like a natural phenomena. Why are markets like a natural phenomena? Because it's actually human beings participating in the market and creating the prices. Okay, the interpretation of news, interpretation of how market prices move, and how they act will be reflected in the prices. So in terms of Dr. Bill Williams' research, okay, in the 1980s, okay, into the theory of chaos and quantum mechanics, he was the first to apply this fractal theory into markets, okay, and develop one of these first indicators into the trading system. Okay, nowadays we can actually what do you call that, using our PC, we can actually have more computing power than during the 1980s when actually Bill Williams was doing their research. Okay, and it's actually very interesting research. The team from Bill Williams, they were like looking for the, how shall we say, it's like, what is the code of the market? Okay, what is like like from the movie, what is the Da Vinci Code of these markets? Okay, so they went on this journey, and at that time they were using mainframe computers. Okay, and they tried to pinpoint what is the underlying structure of the Elliott wave. He is also a keen student of the Elliott wave, and he wanted to find out what is the underlying structure. Okay, and they were using quite, as you say, this chaos theory, very sophisticated nonlinear feedback calculus, blah blah, blah, this high sounding programs, okay, to extract the exact fractal points in any chart, okay. And what they found out was in thousands of charts that they studied, they were able to identify that particular code, and they of course called it a fractal. And it was a very consistent pattern, okay, that forms in any time frame of any market, okay. And they also found out when they extrapolated those fractals in the computer onto the charts, they were able to actually reflect about 98% of those points, those fractal points, by computer. Okay, what does that mean? That means that the pattern recognition actually allows a person, okay, to trade the fractals without using a mainframe computer. Of course, we know that these days the PCs are even more powerful than the mainframes in the 1980s, right? So you are actually able to see the pattern. If you understand the pattern, you can see it with your own eyes. You don't even need a very specialized computer to recognize these fractal points, okay. And actually right in front of you, right in front of your eyes now, is the pattern, okay. You will see this pattern over here, okay. And the two arrowheads are the identified fractal points, okay. So what is this fractal indicator aims to detect? Okay, it aims to detect reversal points through the highs and lows. Okay, you can see here, these are the highs and these are the lows. Okay, and there's a rule to how these highs and lows become a fractal. Okay, basically, fractal is defined as a bar which must have two preceding and two following bars with lower highs, higher lows on a down move. Okay, this is very wordy and very, what do you call that? So I'm going to show you a picture, because a picture is worth 1,000 words. We go to the next slide. Okay, all these things, all these bars you see on the left side of this slide are fractals. Okay, so the red arrow point here denotes the fractal point. Okay, so basically a fractal pattern on a chart, and this is on any time span. Okay, it can be any time frame, it can be an hourly chart, it can be a daily chart, it can be a 5-minute chart, it can be a monthly chart. And you say, I want to be funny, I want a 3-minute chart or 2.5-minute chart. If your software can display a 2.5-minute chart, all these patterns will show. Okay, and that's the very interesting part of fractals, is in any particular time dimension, okay, it will display these patterns. Okay, so it has become some sort of a, how shall we say, it's like the law of gravity. So in looking at charts, price charts, this is like the law of the charts. Okay, and there are actually a lot of other traders who have identified this pattern. Okay, some of them have written different books about it. But the interesting thing about Bill Williams is able to formulate it into this, and you can use it actually as one of the indicators on the technical analysis chart. Okay, we'll of course go in and study all these types of fractals. Okay, so an easy way to identify a fractal is if you are sitting there and if you put your hand out, in front of your face, okay, and you're upright with your fingers pointing upwards to the ceiling, okay, you will look like this particular first fractal over here. So your middle finger with the two other fingers left and right, which is lower, your middle finger, if you have normal fingers, of course, I have normal fingers and my middle finger is the tallest of all. So if you put that up, that middle finger is actually your fractal. Okay, and that's called the up fractal because it's pointing upwards. And if you turn your hand downwards and to point to your table or point to your floor, the lowest, of course, your middle finger again, the lowest finger, which is a middle finger, is actually the down fractal. Okay, so if you have that, of course, is what we call a perfect formed fractal with a very regular two left hand and two on the right, which is lower than the middle one. Okay, of course, you have other fractals which looks like this, so long as the left and right, in terms of this arrow here, the left and right, two or more of bars are below and on the left and below on the right of this middle bar. Okay, so the middle bar must have a higher high. Okay, or if it's a down fractal, it must have a lower low than the two preceding bars and the two following bars. Okay, so that is in words how it defined as a fractal. Now, during the 1990s, when I was first using fractals, I had to draw it by hand because there was no software that actually could decipher the fractals. So I had to draw it by hand in a chart or on a computer. I would have to mark those points with an arrowhead. Okay, but these days, a lot of this technical analysis software, you can actually have this Williams fractal displayed for you automatically. You don't even have to go and count the five bar and the formation. So most of these technical analysis software nowadays can display the fractals. Okay, so this definition over here is for those who don't have a software that can display it, then they will have to look out for and count it manually, right? And here is a chart that I'm showing you, and this is a chart from my program. I use tradingview.com, and it automatically draws the fractals over here. You can see the green arrowheads, okay, and the green arrowheads are the up fractals, and the red arrowheads are the down fractals. So it's automatically drawn for you, right? You can see over here, just give you an example right over here. This is the up fractal. You can see two bars with lower highs on the left, and then you have a couple of bars below. Okay, the minimum is to have two bars on the left and two bars on the right, which is lower. It can be more. Okay, as you can see here, there's more than two, but the minimum is two, and the minimum number of bars is 5 bars to create a fractal. Okay, so that is the what do you call that? That is the key identification of the DNA of the market. Okay, and why are these fractals important? Okay, all these arrowheads, when you join them up, okay, it will become what we call the Elliott wave. Okay, and if you see in the next okay, I'll have some examples for you later on the Elliott wave. But before that, just to let you know, once you join these lines, all these lines, okay, if let's say, for example, over here, let's see whether I can draw this line, okay. So when you draw these lines, okay, and this is a palm oil chart, and this is a weekly palm oil chart, okay. It will form, oh, sorry, okay, it will form the Elliott wave, okay, in 1 degree or another. Okay, so it will form this this wave. Okay, and if you can recognize this particular join line, is of course this is a downtrend. Okay, and this is a slight correction and then a continuous downtrend. Okay, and it is important to be able to see these trends as well. The next couple of slides will have a quick run through the pattern recognitions on trends. Okay, and we will use that pattern recognition together with fractals to determine our entry and exits afterwards. Okay, so let me just remove these drawings and then let's go to the next slide. Okay. Non-drawing mode. Okay, let's go. So here we are. Okay, in terms, this one I'll run through quickly because it's something that you can recognize with your eyes. Okay, this is of course a quickly look at it. You know, it's a bullish trend. Okay, and a bullish trend is defined by higher highs and higher lows, right? And all these highs and lows typically are fractal points. Okay, later we'll have a quick look of that. This is a bearish trend, of course. A bearish trend defined as a market with lower highs and lower lows. Okay, you can see all the highs are moving lower and all the lows are moving lower, and all these high low points are usually fractal points. Okay, and of course, this is a sideways market. Immediately, a sideways market is a market where the upper range and the lower range is quite well defined. Of course, this is not an easy market to trade in terms of trend traders. A lot of traders actually lose money in sideways markets, and it actually this phase of the market actually contributes to large drawdowns if you are trading a trend trading system. Okay, of course you can be what do you call that, a reversal, what do you call that, contra trend trader or counter trend trader, and this will be a profitable area for you to trade if you are trading counter trend. Okay, so we have three types of market: upwards, downwards, and sideways. Okay, and I want to talk to you about this reversal. Okay, this is a very important point in terms of looking for reversals in a trend. Okay, in this picture you can see here on the left side of this is the uptrend, and then the right side is of course the downtrend. And the key thing here is to recognize where the markets turn. Okay, and this is the turning point, is where the markets which is on the way up does not make a new high and then breaks the new low. Okay, a failure to create new highs, as here this particular price did not create a new high and then it breaks this low. Okay, and this is where you will see later what we call an ABC fractal breakdown. Okay, it's a sell signal. Okay, and this particular price point is very important. This recent low is very important, and that's where we were going to look when we look at the entries and exits. Okay, this is how it looks like. So in terms of trading, where we have a fractal high followed by a fractal low, and then possibly another fractal high, which does not create high, and comes down and breaks through the fractal low, then you have what we call a stop and reverse or a breakthrough sell. Okay, so if you are long, okay, if you are long this market and then you have this particular signal, when it breaks this price point, you have what we call a stop and reverse. Okay, you stop all your longs and you go and reverse into a sell. Okay, so this is the key reversal point, which is the ABC sell or buy signals that we will look at afterwards. So in a downwards market, which is reversing to the upside, okay, it's the same thing. You have a market that's creating lower lows, then fails to create a new low, and then takes out this high. And that's where the reversal buy setup is. Later we will see in the AB system, that's where the buy point is triggered. Okay, and in terms of looking at the rally sell, this is an example. If it's a downtrend, you sell the rallies, but there's one point here: you cannot sell the rallies, okay, because it's already broken this high. Okay, it failed to create new low, it break this high, and this is a stop and reverse buy. So if you are in a position on the short side, you will stop all your shorts and then reverse to the buy. Okay. And this is the example that I wanted to show you of fractals, and also with the trends where the fractals actually define the Elliott wave. Okay, so between this fractal and this fractal is 1 degree of the Elliott wave in a particular time, and this is a 15 minutes chart. Okay, you can see over here lower low, lower highs, and each of these lows are defined by the fractals, and each break of this fractal successively sees the market continue to go down. Okay, this is the 15-minute chart. Give you the example of an hourly chart. Okay, so in terms of this is in September, end of September. From here, there was an uptrend, and then sorry, this is August, and in the third quarter of September, it made a high around 3001, and then you can see the fractals coming down. Okay, we will identify all these buy and sell signals later in the ABC entry and exit system. Okay, so you can see that all these fractals, okay, consistently is a repetitive pattern. Every single what do you call that, chart, whatever the time frame, it will display the fractals. Okay, this is a daily chart. Okay, you can see in all the trends. Okay, so what we need to know is, of course, number one, how to recognize the fractal, which I already defined in the previous chart. And of course, if you have a software like TradingView, you can actually, of course, display the fractal. Okay, and this is a weekly chart. Okay, in the same way, you can see the fractals all defined. And oh, okay, there's no monthly chart here. Okay, so we are now going to jump in straight into recognizing the ABC fractal entry and exit systems. Okay, I use ABC in terms just to make the learning a bit easier. Okay, there are more sophisticated terms to use. Bill Williams will use things like initiating fractal and all that. Okay, but I use ABC just to make the learning a bit easier. Okay, so this ABC fractal entry exit system, basically, as I promise you, is a simple system to identify the trade setup. Okay, it does not require any sophisticated and technical analysis software. Already, all these points and all these fractals have been identified in the 1980s by all the mainframes during that time. Okay, and it's already a pattern recognition already identified. Okay, it is quite easy to master if you practice. Okay, of course you need to practice a bit, and every time you use this ABC fractal entry and exit, you will be trading predominantly with the prevailing market trend. Okay, unless the market goes into a very protracted sideways market. If not, when you use the fractals entry and exit system, you will be trading with the trend. Okay, you will never be caught out of the trend. Okay, and you will be also be able to catch early trend reversals. Okay, and it's versatile. It can be applied to all markets and all time frames. Okay, it can be used for palm oil markets. If you trade other Bursa Malaysia markets like the index as well, it also be able to be applied and used, and in all time frames. Okay, now one thing I want to stress is this: a lot of people ask me, hey, this looks so simple. After you learn, you probably looked very simple to you. Does it? Is that all? Okay, and I can tell you, yes, that's about all. Okay, that I use personally. And the interesting thing is, I started this journey in trading by putting a lot of indicators on my charts. Sometimes in my initial stages when I was doing technical analysis, charting and all that, I had so many indicators on the chart I can't even see the price chart. Okay, so the thing is, as I progress and learn more and more, the thing is, I kept removing stuff, okay, until I got down to these basics in fractals. Okay, and I found by using a very simple system, it enables me to be able to act fast and decide fast on what to do every time the market starts to move. Okay, so please don't be although it is incredibly simple, do not be fooled by the simplicity, because there's a lot of science into it. It's just that it's been identified. It's just like very interesting. I always say this: if David Copperfield, if those of you who are old enough to know David Copperfield, he's a very famous magician. Okay, and he has this very elaborate tricks. Okay, now years after David Copperfield came out with the tricks, making a plane disappear and all that, there were magicians who came up to actually tell you how David Copperfield actually did the trick. Okay, and then when you have those like exposés into this all these tricks and say, hey, you look at it, it's so simple only. So the thing is, what you see is, so the wow factor is so what do you call that, so impactful. But if you know the actual secret, sometimes it's actually very simple. Okay, so in terms of trading, if you're going to simplify your trading more and more, and as you progress in your trading, you realize that less is actually more. Okay, and I personally I also design trading system using artificial intelligence, AI, and machine learning. I find that the strategies that I find the most robust has the least complex, or the complexity is the lowest, and they are the most robust and the most profitable. Okay, so this, I wanted to say this because a lot of people ask me, is that all you use? And yes, that's basically all I use, probably added with another momentum indicator. Okay, so let's jump to it, not talk so much. Okay, so this is the first trade signal setup. Okay, so here we have a B fractal, which is an up fractal. Okay, and you have this pattern with A can be a fractal and C can be a fractal, which is lower. Okay, you can see A, B, C. okay, and when it breaks through this B, okay, by one tick, at least one tick, then a buy signal is set up. Okay, so later we'll see some examples. Do not worry about this. I'll give you a lot of examples so that you can understand. So basically, in terms of the bars, okay, you see a market which is coming down. Okay, you see this bars here coming down, and then markets then go up on a correction mode upwards. Then it comes down again. Okay, but this particular time when it came down, it does not break or it does not create a new low lower than A. Okay, the condition is if this movement moves lower than A, then it's a continuation of the downtrend. So it's not a reversal buy. So C is not lower than A, okay, and then it comes and the prices continue to move up and breaks B. And when B trades through B plus one tick, that means it trades higher than the price at B, then you have a valid buy signal. Okay, in that case, you will go long. Okay, if you're already in position, let's say for example, if you have a short position, you can use the ABC long signals to square off your short positions, which is a stop and reverse trade. That means you stop all your shorts and now you take profit and then you go long. Okay, so this is a ABC trade signal for a buy. Okay, and here's an example. This is crude palm oil, and this is a daily chart. Okay, so this is the A, which is a fractal. B is also a fractal. Then it comes down to C. So it needs to have at least, of course, we said in a fractal formation 5 bars, and then you have a C. Okay, and then later after of C is formed, and this C is not lower than A, that's one of the conditions. It takes out the B plus 1, it takes out, and you have a buy at this particular point. Okay, so when you have an ABC, it doesn't mean that once you see this formation, it's a buy already. It needs to break out of this setup. Okay, so once you see this ABC, you have a setup. So you will draw a line across this price and you denote the price as a price at B plus 1 or 2 ticks. You note that price, and when prices trade through it, okay, then you have a buy signal. Okay, a lot of times when I do this is I'll put a buy stop at B plus 1. So automatically then markets, when it goes up there and trigger, it will get me into a position. Okay, so this is an example of the ABC buy or sell. So in terms of a sell signal, it's the opposite. You have the A, then a B, and a C that doesn't exceed A, and then it moves down to break this B. And this time, if it breaks B minus 1, okay, lower than B, then you have a sell signal. Okay. So similarly, if you are long this market before A, and when it breaks B, it's time to take profit and then stop and reverse to go short. Okay, we'll see some examples later in the live charts. Okay, this is another example. This is palm oil daily as well. So you have A here, you have a B here, you have C here, and next couple of bars, when you have the setup, it triggered through, and this is where you will sell. Okay, you actually sell here because it broke through over here. Okay, we will see examples in the live chat. Okay, so yeah, so those are the rules of the ABC trade signal setup. Okay, and how to master this trade fractal setup is you need to be able to identify the wave structure. Okay, by decoding the reversals, you need to practice until the fractal pattern recognition is embedded in your mind. Okay, later we'll go into chart so that it becomes easier. Okay, once you have it, you'll be able to quickly identify the trend and know the entry points for any stock or any commodity market. So we're talking about trading FCPO, of course, this. Now, this is a picture I took of my bathroom. Yes, this is my bathroom mirror. My wife, when she retired, she said she wanted to learn how to trade FCPO. Okay, everybody wants to be an FCPO trader. She wanted to be an FCPO trader. Say, okay, you want to be FCPO trader? I'm going to draw these 2 charts on the mirror every day. When you wash your face and brush your teeth, you look at it and master this. So this is something you need to do. Okay, you don't necessarily have to draw it in the bathroom. Okay, just in case your wife say, what are you doing? You can always pin a little note next to you when you work, so that this whole pattern actually gets embedded in your mind. Okay, so let's look at some charts. Okay, before we talk about managing risk and cutting losses, let's look at some live charts. I'm going to transfer to some live charts. So let's have a look at this live chart. Okay, so I hope it displays well for you. Okay, this is a hourly chart. Okay, and what do we have here? This is today's market action. Okay, so you have a market action where, okay, let me pull this away first. Okay, uh, you have today a high right here. I have a point at 3026. You have an A here, and then it came down. The market came down after that to 2959, and then move back up. So now we have a what we call a, okay, this C will need to change over here. Sorry. Okay, I need to change over here. So C, okay, C is here. So C has not exceeded A. Now, if C exceeds A, we have a different scenario, which I draw for you. So basically, we have a setup. We have a setup at B, which is 2959. If it breaks through to 2958, we have a sell signal. So tomorrow, if market opens and trade through this B point, this point, you have a sell signal, and you will go in and sell FCPO in terms of the hourly chart. Okay, this is hourly chart. Hourly seems to be my favorite time frame. Okay. Now there is another possibility. Okay, the other possibility is this happens. You have A here, you have a B here, and you have a C here. Okay, so you have two possibilities tomorrow when the market opens. Okay, so you can have the market trading through this A, or trading through here, the previous B over here, which is now C. Okay, so in this particular two areas, you have tomorrow a possibility of markets moving up, removing this recent high at B. Okay, and that denotes that it's going to continue with its uptrend in the hourly chart, or it's going to do a reversal. If it doesn't trade through B and goes and come here and trade through this currency, which was the B we saw just now, then you have what we call a reversal of this uptrend on the hourly chart. Okay, so there are two possibilities tomorrow when the market starts to move. Now this is an hourly chart. Let's see. Okay, let's go down to, if you like to trade intraday, let's go to, say, the 5-minute charts. What do we have here? Okay, so in terms of the 5-minute charts, over the last couple of hours of trading today, you could see here, okay, you have, where was the first one? Okay, yeah, you had an A here. Okay, where can I find my ABCs? Okay, A, where's my B? My B's gone up here. Okay, let me bring down the B so that you can see it a bit more clear. Okay, over the last couple of fractals, it was on the up, what do you call that, up. So you have A here, and then you had a B here, okay, and then you had a C over here. Okay, and very interestingly, you see this particular line where we draw, which is currently the A, is actually the sell level just now at B. Okay, so in terms of each, if you go down the time frames, you will see within those waves of the hourly charts, you will have waves in between those hourly charts, which are the 5 minutes and the 15 minutes charts. Okay, so you have a ABC here. Okay, what it did was it did broke out here. Okay, breakout here. So you had actually a buy signal over here, which was triggered over here. Okay, was it stopped out? In terms of, you put a stop here, it didn't stop out. So in terms of this particular signal, you bought at 2986, and now if you're still holding on to this particular trade on the 5 minutes charts, you'll be up. Okay, currently last traded was 3008. So basically you up how many points is that? You have 14 plus 8, you have up 32 points. 14 plus 8, or 22 points, okay, from this entry over here. Okay, and if let's say I go up another time frame, I go up to the daily charts, what do I have? Okay, so in terms of the daily chart, okay, the most recent trigger was here. Okay, you have A, B, C. Okay, and this was probably one of those trades that you probably be stopped out. Okay, this particular trade ABC, it was triggered downwards, but it didn't develop very well, so you probably be stopped out at C. Later we'll look at where to put your stop loss. All right. Okay, we can get to the questions later, but this is just a quick look on the ABC in any time frame. If I go to a weekly time frame, let me show you a weekly time frame, you will also see the buy and sell signals. You have A, B, C here. Okay, you have a A here, you have a B here, and you have a C here. Okay, so this is your ABC. It triggered a buy over here on the. This is a weekly chart, 2, 4, and 5 levels. Of course, in terms of the larger time frame, you go into the each of the trades are of a longer period of time, so more points. And of course, you also the stop losses, the absolute values will also be higher. Okay, so let's get back to the charts. We have still some material to cover over here. We'd like to talk about the, okay, wait a minute. Okay, so let's talk about where to put your stop losses, okay, in terms of managing risk when trading CPO. Very important to always have a stop loss when you trade, okay? Do not trade. For those who are new in trading futures, this is a very important slide to remember. Do not trade if you do not have a defined stop loss strategy, okay? Later we'll see how to have a stop loss strategy. And this is very important because not every trade will become winners, okay? Even in high probability setups like the fractals, there will be losses as well. Those, what I mean is those trades that didn't work out. This time we saw on the daily chart, one of the trades didn't work out, okay? So you need to have a stop loss there. And the purpose of the stop loss is actually to preserve your capital. For the winners that will come, there'll be winners that will come, okay? So you need to have a stop loss to preserve your capital, okay? So in terms of trading, immediately put a stop loss order every time you enter the market. You need to know where you exit before you even enter a trade. That's very, very important. So you need to know the amount of loss that you're going to take on the trade, and you need to put an order there to protect yourself. Right. In terms of stop loss, a very general guideline, of course, is not to put your stop loss that exceed 2 to 5% of account equity. Right. So in terms of number of contracts, make sure that every trade that you do, whether in single contracts or in multiple contracts, it does not exceed, in terms of the total stop loss, does not exceed 2 to 5% of your account equity. Right. So very important. The purpose of the stop loss strategy is basically to enable you to cut loss fast enough so that you have capital to re-enter the market. Right. And this warning here, if you don't have an effective stop loss strategy, it's always a matter of time before you will suffer severe losses. So please, this is a very important slide to remember for those starting out trading futures, right? So remember this. So where to put the stop loss? Okay, in terms of the ABC fractal trade signal stop loss, we will normally put a stop loss either at C or A. Okay, C is of course a more conservative stop loss. It's tighter. You can see the entry price here at B plus 1, and the amount of stop loss here is less than the amount over here. Okay, now the rationale of putting it at A minus 1 is if when it tricks through below A, that means that the whole trend has turned into a downtrend again. Okay, you are basically buying a reversal here at B, hoping for the market to go up, and if it trades through and it goes down below A, basically it's saying that the whole trend has turned back into a what do you call that, a downtrend, right? So you either put the stop at C minus 1 or A minus 1 for a buy signal. Okay, in terms of a sell signal, you also either put it A plus 1 or C plus 1. Okay, C being the more conservative approach because it's a smaller stop loss. Okay, and A is of course the whole reversal of the trend. Right, so that's where we put the technical stop loss for the ABC fractal trade. Okay, we also take a quick look at trailing stops. Okay, I may not have time to cover much, but for those of you, you can review this video again. In terms of looking at not only stop losses, what about when the market is going for you? How do you trail the stops? Okay, normally what I'll do is I will trail my stop at the lowest low of the last 3 to 5 bars. Okay, one tick. Okay, let's say for example, I'll show you later in the charts, market are moving, and then where do I put my stop? As it goes up for me, I'll look at where are the last 3 bar lows, and I'll put one tick below that, and that's my stop. Okay, so if you want to be conservative, it can be 3 ticks, or if you are able to take more risk, then it's 5 bar low. okay, for long positions. Now, there is also another example where the market suddenly takes off in very, very good momentum, and you have this trade really going for you, okay? And sometimes this type of trades where it goes up really fast or goes down very, very fast, it also has a rebound which is very fast. So for these types of markets, okay, where you get five consecutive up or green bars, if you look at the charts, the green bars are, you have five consecutive bars, then I will trail my stop at the low of the fifth bar, okay. That means after the fifth green bar, I will put my stop one tick below the fifth bar and continue to trail the stop every single bar upwards until it takes me up. Okay, now of course describing it, it's a bit difficult. I'll show you later in the chart how that looks like. Okay, and conversely for the short position is the same. If you short, then you will trail it 3 to 5 bars high plus one tick. Okay, either 3 to 5 bars, or you have a very sharp downwards moving market. If you see 5 red bars, continuous consecutive red bars, then I will trail my stop at the high of the fifth bar and continue to trail it at the high of every single bar that comes up until I'm stopped out. Okay, I'll show you in the charts afterwards. Okay, before we get back to the live charts, a quick talk about the what is the, should you day trade or position trade? I want to contrast between day trading and position trading, especially those starting out. When you're talking about day trading, you're basically using time frames of between 1 to 15 minutes. Okay, you can use 1 minute. Of course, the lower the time frame you get into, the more expert you need to be. Okay, but normally for me, if I trade day trades, I will use the 15 minutes for FCPO. Okay, what's good about being a day trader? Of course, there's no overnight risk, there's no gap risk. Okay, and one of the things of FCPO trading is there's always this gap in the morning when it opens because of the overnight soil markets, soil oil markets, and soybean markets. So if you are a day trader, of course, it's more intense in terms of your screen time. You need to be more concentrate and more focused because you're looking for signals in intraday. Okay, but what is the advantage is, of course, you will take comparatively less capital due to the smaller intraday risk, and even potentially some brokers may have intraday margining for day trades. Okay, so you may be able to trade more positions with the same amount of money. Okay, but be alerted. Day trading requires more skill. Okay, although it may seem that it's less risk. Okay, there's more skill and more experience needed due to the trading frequency. Basically, you have signals coming at you, okay, every half an hour or every 1 hour, right? And also a potential volatile drawdowns, whether your trading psychology can take those frequent drawdowns or not. Okay, so this is something that you need to pay attention to. Okay, in terms of position trader, of course, then the time frames for the charts, you look at 60 minutes, dailies, and weeklies. Okay, so you're basically taking a position. Okay, now when you take a position, then you have what we call the overnight risk. Okay, or the weekend risk or the gaps. Okay, but of course the advantage is less screen time needed. So if you are, say, you're working on a full-time job and all that, and you trade palm oil, you may have to trade a position trade. Okay, because you don't have time to lock your eyes on the screen. Okay, and obviously because you take a bigger stop loss in terms of the ABC, then you need to have more capital. Okay, there's more capitalization that you need because your stop loss values are higher. Okay, so basically, but still for novices just starting out, it may be better for you to trade initially start with position trading. Okay, at smaller sizes, maybe 1 lotus or 2 lotus just to start. Then when you get more familiar with the system, if you like the fractal system, then once you have mastered it, then you can go into day trading. Okay, so that's important. Okay, and a quick look here in the average true range. These are the daily average ranges of FCPO, and this was in 5th October. And you can see on the daily basis, the average true range for daily is 75 points. The high-low range is 75 points, and that's a lot. Okay, and even for hourly is 31. 30 minutes 23, and 15 minutes is 15 points. So it's a very volatile and very good market to trade for FCPO. Okay, so now I just want to quickly go to live chat, then I'll spare some time for Q&A. Get your questions ready while I set up this live chat for you to have a look. Okay, So just now we were talking about trading. Okay, so let me give you an example over here. Okay, right here, this is a weekly chart. Okay, maybe not, but never mind. Since the weekly chart, I just wanted to show you example. Okay, this is a, this is a B. Okay, this is a C. Okay, and you got in where? You got in right over here. If you are trading this particular signal, you will, this is the point here. Okay, so you will get in when it breaks here. This is the point where you get in. Okay, now we're talking about where to take profit and all that, right? So in this particular weekly trade, weekly chart trade, you saw that once you got into the market, okay, every week the market continued to move up. Okay, so you ask yourself, hey, where to take profit and where can I maximize this trade? Okay, so I count from here. When I enter, how many green bars do I have? I have 1 bar, 2 bar, 3 bar, 4 bar, 5 bar. Okay, once I have the 5th bar, on the next bar I'll put my stop over here. Okay, this line is 1 tick below here. Okay, and then when it next move to the next bar, I'll move my stop up again to this bar. Okay, this is the bar. Okay, and once it moves again to this particular bar, okay, I will move my stop right here and trail my stop this way. Okay, and then when it moves to this particular bar, I'll move my stop here, and then of course in this particular bar I will be stopped out. Okay, so I would have taken a trade from this B until here. Okay, I may not have fully maximized it, but in this very aggressive market, I got most of the meat from this particular move. Okay, that is the 5 consecutive green bar thing. Okay, now if I'm just following, if I'm not using that 5 green bar thing, then what I will do is, let's say for example, once you get in over here, okay, this is the price you got in. Once you got in here, you will have my stop either at C or A. Normally in this kind of situation, I put my stop at C, because why? Because C is the low of my last 5 bars. 1, 2, 3, 4, 5. Okay, where's my low? My low is at C. Okay, and as the market goes up, let's say market goes up right up to here, then I count where is my low. 1, 2, 3, last 3 bars. Okay, this is where I put my stop. Okay, but as you can see, in a very fast accelerating market, if you put your stops here, it tends to be quite large. Okay, so when I see 5 bars, 5 green bars or 5 red bars down, I would prefer to use the 1 bar stop. Okay, the previous bar after the 5th succeeding bar. Okay, I understand it's very quick, but you have notes to refer to back to the video. You can review it. Okay, because there's so much material I'm covering in this 1 hour. In fact, I've exceeded that already. I'll need to get back to Min Hao from Philip for your questions to come. So back to Min Hao for questions on today's session.
Hey David, thank you for going through all the questions. Let me see, let me pick out the questions for you. All right, the first one is, what is the win rate of ABC seller in various time frames for day trading, swing, and positional trades?
Okay, that is the question I get asked every single session. Okay, now the thing is this: when we talk about profitable trading, okay, we have win rates. Okay, in terms of raw win rates, in terms of my experience, okay, and then it all depends as well. You can always tweak your win rate. Okay, depends on where you take your profits, and taking profits is where the art is, of course, as well. So in terms of trading, I would say the win rate will exceed 40 to 50%. Okay, it also, the other measure of a profitable trading system is what type of profit it gives you in a good move, and what type of stop losses that you take. Okay, so those are variables that will come in when you calculate the profitability of a system. Okay, so in terms of a one-off quick look at what every time it triggers ABC buy fractal, it'll be better than 40 to 50%. Okay, and the rest is all about their win-loss ratio. How much is your profits per trade compared to your losses per trade? Okay, so that's the key. More to me, the money management side, the profitability side, which is more important. And in terms of when you correctly lock yourself into a trade using the ABC fractal, because you are trading predominantly with the trend, what do you call that, your profits and all that will cover most of the losses that you have. So you have smaller losses and very large profits, right? So as I showed just now, methods of trading the stops and also the 5 bar taking profit all depends on what technique that you use. So if you want me to pin it on a very specific figure, I may not be able to pick that figure out for you. I hope that answers the question. Back to you, Min Hao.
Well, David, let me see. Minhao is helping me pick out the questions.
Oh, okay.
All right. So next question is, how would I know if there is a false breakout? Should I average my entry if it moves against me?
Okay. In terms of trading, as you can see, this is a breakout method of trading. Okay. So as a trader for breakout, sometimes you have this frustration of trading the breakouts. Okay. And there's one way to filter out your breakouts, which I didn't show here. But let me go to chart and quickly show you how to use this. Okay, you can use this is also Bill Williams. Okay, for those of you who want to venture into studying more about what Bill Williams trading systems, I would recommend you read Bill Williams, the book called Trading Chaos. Okay, and in Trading Chaos, he will introduce this alligator. Okay, and this alligator is a what do you call that? A three-line moving averages. Okay, and what Bill Williams say that if you want to be if you want to reduce the what do you call that, false breakouts, okay, then you want to trade the ABC fractal breakouts. If you want to buy, you want to trade the fractal breakout when it's above the three lines. The three lines is what you call the alligator. As you can see here, this particular breakout is above the three lines. It has filtered out the bracketed markets. Okay, so let's say for example over here, okay, in terms of taking the signal, okay, this particular signal is okay, but let's say for example you have the ABC sell over here, okay, and it's above. You don't want to sell when the market's on above. You only want to sell when it's below the alligator. So one of the ways to reduce the false breakouts is to use a filter, and one of the filters that I use for that is using the alligator. Okay, unfortunately, I don't have too much time to go and elaborate on that. I'll point you to go and have a look and reference Bill Williams' material to look at how he uses the alligator to filter out the ABC fractal trade. Okay, I hope that answers your question. Back to you.
All right. This is should be a very important question for new traders. How do you know which contract month you should trade? Is there a most liquid contract month that is best to trade? Or how do you
Okay.
roll over to the next contract month when is the best time to do so?
Okay, for the crude palm oil, the most active month is the third month. Okay, so in terms of currently now we are in October, the most active month is of course is in December. If you take a look at go to Bursa Malaysia's website and you look at the quotes, and even if you go to say the Phillips platform, and you look at the different contracts with the volume, you see the third month as being the most volume, right? Now, in terms of the next couple of days, we will be going into January, okay, as one of the months expire. And if let's say, for example, I am in a position, let's say I take a position tomorrow, okay, tomorrow is the 14th, it's one day before the last day already. Now, let's say, for example, just now we're talking about the ABC buy, right? So we bought, market continue to go up, and then I'm holding a pretty good position. Okay, now once you get into the second month, it's still not the spot month, right? So you can basically, if you are trading an hourly chart, you expect yourself to take profit maybe in the next 2 or 3 days. So that's still a very viable, can still continue to hold the December month for a few more days, right? Because so long as you don't hold it until it becomes the very close to the spot month, you may not be at risk so much. The risk is if you holding a spot month, which most brokers will not let you to do that. Okay, so if let's say we're holding a daily chart and then you need to roll over, of course you need to try to roll over. That means if you are in a long position, you want to sell sell your current position and move to say move to the January month. Okay, so in that sense, you need to see what's the gap, what's the spread between the what do you call that, the December and the January month. Okay, and you will try to roll it over. That means you will, let's say you are long December, you will sell December and then long January to continue your position. Try to see whether you can do that with the least difference in the price of December and January. Okay, but basically, if you are trading and you are only in the market for the next couple of days, you're not trading a very long position trade, then all the traders normally will only trade the third month. Okay, I hope that answers the question. Very important to trade the most liquid month. That's where you get most liquidity and the bid offer spreads are the tightest. Okay, back to you.
All right, David, this is the final question, so I'm going to make it a bit more challenging. It's going to be a
Ah,
two-parter.
okay.
All right, so for this ABC setup, is it better to know the major trend so that the probability of success is higher? If
Mm,
so, how would you determine the major trend? Do you
mm.
use other technical indicators to help you in trend identification? So there's a three-set question.
Okay, thank you very much for a very, very good question. Now, as we said just now, all the fractals define each of the Elliott wave in different time frames. Okay. Now, there is of course more sophisticated ways of reading which phase or which long-term trend the market is trading it. Okay. But one quick and dirty way is, let's say, for example, if you're trading let me see, let's say I'm trading a 15-minute intraday chart. Okay, now this is a 15-minute intraday chart. Okay, now if I move up one time frame up, okay, so this in this sense, if I'm trading this, if I look at the hourly chart, okay, let me see what's the hourly trend. Okay, so in terms of hourly trend, I can see that I'm on the up wave as well. Looking at the fractals, right? It's all pointing upwards and breaking all the up fractals onwards. So in terms of my one time frame above chart, okay, which is a higher time frame from my current trading chart, which is 15 minutes, I have the hourly chart in a what do you call that? In a uptrend. So I might want to trade, okay, the 15 minutes charts on the uptrend as well. Okay. Now, one good thing about that as well, if you are using the alligator, it will filter for you as well, right? Like right here, you see these are the sideways markets and the false breakouts. Okay, you don't take these signals, and you take this particular signal which is above the three lines. You see this signal. Of course, this is a gap. Sometimes a bit disappointing with Bursa is these gaps do happen, but still it's a valid signal. It's traded above this particular point right here. Okay, right here, this particular price, and it's in synchrony. So your 5 minute, your 15-minute chart is in synchrony with your hourly charts. Okay. The other way to do it, which is a bit more complicated, is you need to learn how to trade the Elliott wave. Okay, that's a good thing if you want to delve into that complexity. But for me, if I want to see, I either go up 2 time frames up. I can even go into a daily chart, okay, and see whether I'm in synchrony or not. So in terms of a daily chart, I see that the highs are keeping getting higher. So in terms of daily, hourly, and also 15 minutes, I'm on the correct trend. Okay. Now the thing of it, you need to think yourself is this: in terms of the first signal for reversal as well will come firstly from your 15-minute chart. Okay, so your 15-minute chart will be the first chart to form a reversal of a trend, right? And then only it will trigger the hourly, and then only we will trigger the daily chart. Okay, so sometimes you also need to look at that particular consideration. So if you say, okay, I don't trade reversals until the trend is clear, then you have to forego some of the early signals as well. So in that sense, there is a bit of balance that you need to play if you use a longer time frame chart as a reference for the trend. Okay, so yeah, it's a very, very good question. There are various ways to do it. Various ways to do it. You can use the alligator as your filter, and you can use also the higher time frame as your reference to trade in synchrony with your current time frame. So I hope that answers your question. Okay, back to you, Phillips.
All right, unfortunately, that's all the time we have for today. Thank you for being a wonderful and thoroughly engaged audience today. And once again, very special thanks to our special guest, David Low. He's the managing partner of X Motors Trading Group. It's a consultancy firm that specializes in bespoke trading strategies. And I hope you thoroughly enjoy his sharing today. Thank you,
Thank you
David.
very much. Thank you very much, everybody. Good night.
All right, thank you everyone for being here. Do give us your comments and views and feedback in the survey form, which you will have access to once we end the session. And let us know if you like to hear more of David or you want more sessions like this. Thank you so much. Have a good night.